Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. As a value investor, valuation is very, very important to me. And there's nothing I like better than be able to find really a great company that's finally attractively valued, that has been fully valued for many, many years. And I've got one of those for you today in PepsiCo company. Now, PepsiCo is a Dividend King that has increased its dividend every year for 53 consecutive years. So if steady growing income is one of your goals as an investor, PepsiCo, I believe, really fits that bill. So let's go into FastGraphs and let's analyze PepsiCo today based on valuation as well as fiscal fitness and financial health. So as usual, I'm going to start with an operating earnings look at Pepsi. I'm looking at adjusted operating earnings here. And as you can see, Pepsi has steadily increased their adjusted operating earnings, and they've grown them at a rate of about 6.68%, which is moderate good growth. But the white line on this graph is the dividends plotted every year since 2003, or 2004 actually. And as you can see, the dividend has steadily increased each and every year that the company has paid a dividend. The green shaded area is this area below the white line, which is the portion of earnings that were paid out in dividends, or the payout ratio. It's called the dividend payout ratio. All right, now you can take that off there. Just some people just like to look at earnings and dividends, but you can see Pepsi pays about 65 to 70% of their earnings out as dividends each year. It is a dividend growth company. You're currently looking at it with a yield of 3.51%, an earnings yield of 5.29%, which is a little below my normal 6.5% to 7% earnings yield that I like. But Pepsi, because of its brand power, has routinely commanded a premium valuation. The blue line on this graph is a PE of just under 21, or we'll call it roughly 20 times earnings. The orange line is 15 times earnings. Now, coming out of the recession of 08 and 09, after Pepsi's stock price fell, even though their earnings actually held up during the Great Recession, I think that's very important to note, that they continue to be profitable even during the Great Recession. And they had a very little stress in earnings even during COVID, which is this gray shaded area here. But there was a really great opportunity for about 3.5, 4 years here where you could have bought Pepsi at very attractive valuations under their normal 20, 21 times earnings. We have that again here. Okay, Pepsi is trading at a blended PE of 18.9. Currently, it did get down a little below that just a little while ago. Now, the stock is, last I looked, down again today. So let's take a quick look at Yahoo. Yeah, it's down almost 3%. So we're still looking at an opportunity to buy Pepsi below its traditional premium valuation that the market likes to put on it. Now, let's analyze earnings here for a moment, because there's some important things that I want to look at. I started out with Max, as I always do, and this just shows me that Pepsi has been a very consistent, steady grower historically, and they've increased their dividend every year for 53 years in a row. And that, to me, is significant when you're looking as an income investor. This means your yield is increasing every year. I call it growth yield. Other people call it yield on cost, and that's routinely what it's called. But let's play around here with the timing a little bit. Let's drop about 4 years or so off of the graph. And now we see the Pepsi over this time frame, which starts in 2013, averaged about 5.9%. Now I want to make a point. 6.68% and now 5.9% is different, but it's not that different. It's a 5 or 6% grower is what I'm trying to get at. But it is slower than it was long-term. Let's drop it another 5 years to 10 years. Now we're back to about 6.36%, and I'm going to drop it now to 5 years, and we're looking at 7% over the last 2 years, really, and then 3 years of forecast. Talking about forecast real quick, Pepsi is expected to grow at about 5.96% by 20 analysts that are following the company. So we're still looking at what I would say normal growth, 5 to 7% growth, we'll call it, for this Dividend King that's increased its dividend. But what I really want you to note is that was trading at really premium valuations coming out of COVID here, were 27, 28 multiples. But now we can buy it for less than a 20 multiple with a 3% dividend yield. So from an earnings point of view, that's attractive. Now that's operating earnings, which is more cash flow oriented. Let's look at diluted earnings, which includes things like preferred shares and options and things like that. And we do see a little different picture. Now, I don't like to look at valuation. I often take the price of. I just like to see what's going on as far as depreciation schedules and amortization and so on when I'm looking at diluted earnings. But what I really like to look at when I'm looking at dividend-paying stocks is operating cash flow. Now, here's the key. I want to see the operating cash flow, which is the orange line per share. As you can see, it was $2.92, and they paid 85 cents. In 2023, it was $9.72 of operating cash flow, and they paid $4.94. My point is they've got ample cash flow to pay the dividend. Now, interestingly enough, though, even though I really like this metric, and I also like the free cash flow metric when I'm looking at a dividend-paying stock, because I want to see free cash flow higher than dividend. Now, this is a little bit of a red flag, we'll call it. If you look at since the COVID era, we've had 2-3 times where the dividend was not covered by free cash flow to equity or just barely being covered by free cash flow to equity. So that's kind of a red flag, but that's expected to improve going forward. But here's another point I want to make. There's more than one way to value a stock. I usually do earnings in my high-level videos, but if I look at price to cash flow from Pepsi as a valuation reference metric, it is typically traded at around 16 times cash flow. It's around 18 times free cash flow right now. And so it would be a little expensive on a price to free cash flow basis. But if I'm looking at a free cash flow basis, it's not really much of a correlation because this is simply the money left over to run the business. So from a valuation reference, I like operating cash flow and I like operating earnings. But I've also got EBITDA, earnings before interest, taxes, depreciation, and amortization. And as you can see, the normal fair value ratio of price to EBITDA has been somewhere around 12. Now, again, coming out of the recession, there was this period of 4 or 5 years where it was trading at not even into single digits times EBITDA. But generally speaking, it's traded at about 12.5 times EBITDA. It got, again, very expensive the last several years. It's now trading at a discount to its normal price to EBITDA. And once again, if I was doing my own deep analysis, not just a video, I would run the different time frames here and note the changes in the growth rates. Being able to do this quickly is a very important feature of fast graphs. It allows you to really determine if a company's earnings growth is increasing, decreasing, or staying the same. In this case, we're looking at EBITDA, of course. And then EBITDA is more of a cash flow metric. EBIT is more of a quality of earnings before interest and taxes. And EBIT does include amortization and so on, but this gives you another nice look. It's growing at about 6%. And we see that PepsiCo is currently trading at a price to EBIT that is below historical norms. In other words, it's at good value now, and we are expecting, I'm going to say normal growth, maybe slightly less going forward than what we've seen historically, okay, 5.14%. And then finally, I'm going to look at the company from a price to sales point of view. This is another valuation reference that I think is very useful. And people ask me, which ones do I use? I always, when I'm reviewing the stock myself, I'm always going to look at all these metrics, especially with fast graphs, because they're just right at my fingertips. I can look at them so quickly. And a normal price to sales for Pepsi has been somewhere around 2.5. Now, when you understand that, when you're looking at this, there was a time when it was trading at much higher 3 times sales numbers coming into 08 and 09. And then as we come out of 08 and 09, for a period of time, it traded at 1.8 to 2 times sales. And then again, we had this period where higher. So when you're looking at this number as a historical reference, it should be clear to you that Pepsi is now trading at a historically normal, reasonable valuation compared to times when it's traded at much higher multiples. And of course, the payout ratio to sales is obviously very low, but you can still see the dividend income. So let's take a glance at performance now, and let's look at the stock from a standpoint of how it's performed historically. Now, the main focus here is on dividends and dividend income. The company, over the time frame that I'm showing here, which goes back to '03, has actually underperformed the market. As you saw in videos I did on sectors, the market is trading at a premium valuation. Pepsi's currently undervalued. So it's kind of an unfair comparison, but the income is what the story is here. And so Pepsi has produced on a $10,000 one-time investment over $12,000 in income versus the S&P, which has produced less than $7,000 in income. But more importantly, back in fiscal year 2004, Pepsi had pretty strong dividend growth that year, but their dividend was actually low. Okay, their dividend was 85 cents per share. Now, I don't want to say, I didn't mean to say low, but it was 85 cents a share. Their yield on cost was about 1.8%. Now, by the way, I want to focus on that as well. So I'm going to go back again into the historical graph here and just look at what valuation looked like. I'm going to look at it from a standpoint of operating earnings again, because that's one that I typically stick to. And I want you to note that it was trading at about a 22 PE ratio, or a relatively high valuation, much higher than it is now. So what we've had about 6.5% growth, but we've had PE ratio contraction. Okay, so it's underperformed the market a little bit, which is still trading at a premium valuation. But from an income point of view, if you're looking for dividend income, as I stated in the beginning of this video, Pepsi really fits the bill. Now, in 2004, because of the high valuation, you'd have started out with a 1.8% dividend yield on cost, okay? I call it growth yield. But they raised their dividend each year since then. They raised it from 85 cents to $1.01. That would have raised your yield the second year you owned it to 2.17%. And if you invested $10,000 and put it in perspective, the first year you get $182. The second year you got $216. And every year since, your dividend has increased to where last year on a simple $10,000 investment in 2023, you'd have received $1,060 in income, and you're scheduled to receive $1,100 in 2024 if everything continues to function as they have. So this earnings yield has grown to over 11% from 1%. Your yield has increased tenfold. And that's what makes a stock an income champion like PepsiCo, where you've got a dividend king and dividend champion and so on, very attractive for an income investor. It's a dividend income that you can count on. But now let's go ahead and look a little further. Let's look at fiscal fitness for a real quick glance, and let's look at some important metrics. Now, again, because it's a dividend stock, I want to see free cash flow greater than the dividend. Well, free cash flow is the green bar. We have had a couple of periods where the free cash flow, recently as 2022, we did have free cash flow slightly underperforming, but in 2023 it was greater again. It's expected to be greater again this year. Operating cash flow, which is a very important one as well, and we've had growth of operating cash flow of about 6% a year. Now, on an absolute basis, it's important to look at, we're seeing that the company's generating almost $10 a share in operating cash flow. Okay, and the stock trades at 151. Share buybacks are another thing that's important to look at. And let's go back to the long-term time frame. You can see that Pepsi maintained 1.78 billion shares outstanding, and then it dropped to 1.6 billion, and then it stayed that way until it got to 1.5 billion, and then it got to 1.4 billion, and so on and so forth. So you're looking at share buyback of about minus 1.17%. They're basically maintaining their share count is how I look at it. Now, I like to see operating cash flow. That was another test greater than net income, as I looked at free cash flow greater than income. And Pepsi does real well here. We see that operating cash flow has been basically, the orange bar has been above the green bar in every year except 2018. Okay, so that's pretty strong. Sales revenue, we look at revenue growth, has averaged about 6.18% growth, which is consistent with their earnings growth. Net income has grown by about 4% a year. Their debt to equity ratio has actually been improving for the last 3 years, But when you look at it from that standpoint, a debt to equity ratio is about 216 times on an absolute basis. Margins are critically important, so let's look at gross margins. The thing I like about PepsiCo is it's very, very consistent. You can see their gross margins have been 50 or above historically. Operating margin got a little bit weaker in the last couple of years, but still very healthy at about over 14%. And their net margin is holding up at around 9 or 10% over the last several years. And again, I'm looking at it yearly here. I can also look at it quarterly, and I can also look at it in gross numbers with the Fast Graph tool. But yearly is good enough for what I'm trying to do here right now. So the company's margins have been consistent. If there's one thing about Pepsi I like, it's consistency. Asset turnover has been relatively consistent. They're turning their assets over about 1 time a year. The return on assets has been holding up at around 8 or 9% or higher each year. Their return on equity is sitting around 50.9%. The return on invested capital is hovering around 16%. So from a fiscal fitness point of view, the company looks very, very good. Now I can also go into fund graphs. If I'm making the decision to buy the stock, I'm going to look at things like cash and short-term investments. I want to see how they've been doing recently. I want to look at long-term debt versus total debt. And what I see is the majority of Pepsi's debt is long-term, and that's a good thing. That means they've got flexibility in handling their debt. I can also go through their income statement. I can go through their cash flow statement using the fund graphs, but I can also look at ratios. Now, I can look at this data in per share or in millions, but ratios is another one I really like. So from a liquidity ratio, well, let's look at their current ratio. Their current ratio is 0.85. That's healthy. That's not, I'd like to see it at 1 or better. The quick ratio, which is the blue line here, is at 0.68. It's healthy, but it's not great. Long-term debt to capital and long-term debt to equity are showing improvements in both of those metrics. Now, profitability, we went through all these before in the fiscal fitness, so I'm not going to go through them again. But I am seeing a company here that's very, very consistent. Their operating cash flow to EBITDA shows their cash conversion ratio is pretty strong as well. I'm going to get rid of some of these metrics here. Okay, and then I can also look at some of the valuation ratios that are really important. And enterprise value to EBITDA is one that I like to focus on, and it's still very strong. It's weakened a little bit in 2023, but it's held up there 18, 15 times, which means it's actually, the stock is getting cheaper is what this is saying. The price to book, I don't think really matters too much, and we've already looked at a lot of these other metrics. So the next thing I want to do is let's go into Pepsi itself. Let's go into the website right out of the fast graphs, which I can do. And let's just think about what the company is and who they are a little bit. And obviously, the quick way to do that is just look at their brands. Pepsi, compared to some of its competitors, for example, compared to Coca-Cola, which has similar characteristics that the market likes to fully value, but it's not the bargain that Pepsi is currently. And I can say the same thing about Nestle. Nestle is getting a little bit more attractively valued. But again, if I go back into PepsiCo, I can see that the company's brands are really diverse relative to, let's say, Coca-Cola. Their products are not only the soft drinks, they've got the snacks, the potato chips, hummus, and most of them, they've also, we can go into their snacks.com and look at all the snacks that the company sells. We can go look at their baked goods that they sell. So it's a diverse company, but it's a consumer staple that's extremely consistent. And bottom line, to kind of close the video out, what I like about Pepsi is I can buy it now. Now, Pepsi's not going to make you rich. It's going to maintain your money. It's going to grow it at a higher rate than inflation, and it's going to give you more income than you can get by investing in an index or a lot of stocks. And the fact that you're starting out with a 3% dividend yield, this is one of the higher dividend yields that you've been able to enter Pepsi at, other than way back here. So my point being is, other than during the Great Recession, Pepsi has given us an opportunity to buy it at a 3% yield. That's typically a very attractive point to enter the stock. So I like Pepsi a lot. I think it's more attractive than its main competitors at this point. I like the diversity of its product mix. I like the consistency of its dividend payment. But this is primarily an income vehicle for those investors who are looking for that consistent income. Anyway, this has been Chuck Carnevale, co-founder of Fast Graphs, giving you my look at Pepsi with a little more in-depth look through Fast Graphs. And hopefully you got the realization that Fast Graphs gives you a lot of ways to look at a company very, very quickly, where you can really get different looks at valuation references and make a more informed decision than you could just by looking at numbers on a spreadsheet. The graphic stories that Fast Graphs tell are exceptional in my view. Thanks for watching. If you liked the video, give me a like. Ring the bell so you get alerted to new videos. And I'll be talking to everybody soon. I'm going to keep doing these more in-depth looks at individual companies through the lens of the Fast Graph research tool. Thanks for watching. And if you haven't subscribed to Fast Graphs, you might also want to take a look at that. Thanks again.